Welcome to the deep dive. Today we are taking the ultimate shortcut into the financial strategies that really define the global elite.
hmm
We're pulling back the curtain on the secret handshake of wealth, the sophisticated, and I should stress, legal methods that allow the top fraction of a percent to grow these massive fortunes while reporting, effectively zero taxable income year after year.
That's right. Our mission today is customized for you, the listener, to break down two interlocking concepts: the buy, bar, die, or BBD tax strategy, and the highly complex machinery of offshore financial structuring.
And we've got some great sources for this.
We do everything from investigative leaks like the Pandora papers to some really detailed CPA analyses. And we're going to try and use the Feynman technique here to simplify what seems impossible, understanding exactly how wealth can legally sidestep taxation entirely.
Okay, let's unpack this immediately. Before we get into the mechanisms themselves, we have to address this core conceptual hurdle that honestly trips up most people looking at this.
It does.
It all comes down to a distinction that governs the entire tax game: income versus wealth.
This is the absolute foundation. The vast majority of taxpayers live in a world where taxes are assessed on income.
So wages, commissions, sales, dividends.
Right. Or realized capital gains. That's key. Assets you actually sold for cash. But here is the critical insight. Taxes are fundamentally not assessed on unrealized wealth appreciation.
So let me get this straight. If I buy a piece of, say, specialized land for $1 million and 30 years later it's valued at $50 million, that $49 million gain is not income.
Not a penny of it. Not until you hit the sell button.
And if I never hit the sell button?
You never owe tax on that growth. It just remains classified as wealth, not income.
And that is the essential rule the ultra-wealthy exploit.
It's their entire financial life. It's structured around two goals. First, maximizing the growth of that unrealized wealth, and second, ensuring that the money they access for their lifestyle, the yachts, the mansions, the private equity deals, is classified as something other than taxable income.
If they can sidestep creating taxable income, they sidestep taxes. It's that simple.
It really is.
This classification game brings us to our two star players. First, the buy, borrow, die method, BBD.
Right.
This is a three-step process. It's designed to continuously build wealth, access cash tax-free when you need it, and then ultimately pass that fortune to your heirs without ever triggering that lifetime capital gains tax bill.
And the second player is offshore structuring. This involves using legal entities, holding companies, and trusts in places we often call offshore financial centers, or OFCs.
Like the Cayman Islands, BVI, Luxembourg.
Exactly. This process legally separates the wealthy individual from their assets, and that provides these critical layers of privacy, flexibility, and of course, powerful tax advantages across borders.
Our sources provide a key mindset shift that just encapsulates the strategy perfectly, and it's critical for you, the listener, to grasp this. It's the rich don't own anything, their companies do.
Think about that for a second.
It's a huge shift. If you're a salaried employee, your income is visible, it's taxed, it's automatically withheld by default. The ultra-rich flip that logic completely. They create entities, companies, trusts that own the assets and receive the income. The person is merely the beneficiary or controller, not the legal owner.
And that legal separation is the firewall. It's everything. If you are not the legal owner, the assets are harder for your home government to tax, much harder to seize in a lawsuit, and frankly, much harder for any single government to even track or categorize as personal income.
This is also where we need to spend a moment on a crucial distinction that gets so mixed up in public conversation.
Right.
Tax avoidance versus tax evasion.
Oh, this is a vital distinction. One is legal, one is a crime.
Right.
Tax evasion is illegal. That's, hiding cash income under the mattress, using fake invoices, deliberately failing to report legally owed taxes. That leads to audits, penalties, and, criminal charges.
But the entire system we're talking about today, BBD and sophisticated offshore structuring, is built on aggressive, high-level tax avoidance.
And this is entirely legal. It means using the rules, the deductions, the specific gaps and loopholes written right into national and international tax law to reduce what is owed.
It's about following the letter of the law.
To a T. Even if the final result seems, grossly unfair, or maybe not what lawmakers intended. The offshore financial machine is a multi-billion-dollar professional industry involving the biggest law firms and banks, built on finding and exploiting these legal gaps for their clients.
Okay, let's use a simple analogy here. Our first one, to really cement this income versus wealth thing before we dive in. Let's look at two people, James and Mike.
Okay.
James is a salaried CEO in San Francisco. He makes $1 million a year. Mike also manages to access $1 million a year, but he's an asset owner who uses these structures we're talking about.
Okay, so James gets $1 million paycheck. His employer reports this as W-2 income, withholds federal, state, and payroll taxes immediately, and pays him what's left.
And depending on the state, James might lose close to half his income to taxes before he even sees a penny. He has zero control.
Right. Mike, on the other hand, technically reports zero salary or wage income.
So how does he get his million?
Mike has set up a complex structure, maybe a trust in Jersey that owns a holding company in Luxembourg, which ultimately owns the highly appreciating assets Mike developed. When that asset generates $1 million in profit, that money flows through these layered entities.
The cash is definitely flowing, but how does Mike get it?
He receives payments, but not as salary. It might be as distributions from the trust, maybe as dividends routed through a low-tax country, or, and this is the most critical part, as non-taxable loans secured by the assets held in the structure.
So the result is the same, $1 million in cash.
Same cash flow, but the tax impact is fundamentally different.
Wait, yeah.
Mike has the legal ability to classify that money as non-income debt or distribution, and that often results in a vastly lower effective tax rate.
The essential difference is classification and control.
That distinction, owning nothing personally but controlling everything through legal entities, is the bedrock of modern high-level wealth management. If the asset and its income are legally separate from the person's tax liability just drops dramatically.
That sets the stage perfectly. Now, let's move to Section 2 and discuss the sheer scale of this, because the systems we're about to describe are not isolated incidents. They represent an entire, massive shadow financial world.
They really do.
Okay, we've established the concept of tax avoidance and this key role of classification, but what does this look like in the real world?
Well, we are not talking about a handful of millionaires stuffing cash into a safe deposit box. This is a massive, highly professionalized, multi-trillion-dollar global system.
And the scale is almost impossible to comprehend.
It really is. Experts estimate that well over $10 trillion in global household financial wealth, and honestly, some estimates go significantly higher, is currently held in these offshore financial centers, or OFCs.
$10 trillion. For context, what does that even mean?
That's more than the entire gross domestic product of Japan and Germany combined. We're talking about roughly 8 to 10% of the world's total household financial wealth just sitting quietly in these jurisdictions.
And when we say OFCs, we mean places that offer this irresistible cocktail of services to the wealthy.
Exactly. Low or zero taxes, strong legal protection, impenetrable privacy laws, and extremely loose regulatory reporting systems compared to, major industrial nations.
Places like the Cayman Islands, the British Virgin Islands, or BVI, Switzerland, Luxembourg.
Singapore, and increasingly certain U.S. states, which we'll get into.
And these centers compete fiercely with each other to attract this business.
Oh, absolutely. Their entire economy is built on selling legal flexibility and financial secrecy. They do this by offering no income tax, no capital gains tax, and often zero corporate tax for foreign-owned entities.
Our sources give a perfect, almost absurd illustration of how these centers function as legal definitions rather than physical locations. The Ugland House in the Cayman Islands.
Right, the Ugland House. It's a relatively modest, 5-story building in Georgetown.
And yet it famously serves as the registered address for over 20,000 companies.
20,000. And this highlights a crucial fact. Offshore assets are legal constructs. They are definitions on paper, not physical offices filled with people. That address simply provides the necessary legal jurisdiction for paper companies, funds, and trusts that hold the trillions of dollars.
It's the legal definition that matters, not the physical presence.
That's it. If you send a legal subpoena to the Ugland House, it gets routed into an incredibly complex legal machine that requires you to then prove ownership through multiple international legal barriers.
And it's not just individuals using this structuring, right?
Not at all. Multinational corporations are using these gaps at a staggering scale, which brings us to the famous case of Apple and Ireland. It's a textbook example of utilizing mismatched international rules.
This story really illustrates how simple changes in definitions can shield just monumental profits.
Indeed. Starting in the early 2000s, Apple structured its operations by setting up 2 Irish subsidiaries. These entities were legally defined as owning the rights to sell Apple products outside of the U.S.
So all the profit from sales across Europe, Asia, Africa
was funneled into these low-tax Irish entities.
And the loophole wasn't an accident. It exploited a fundamental disagreement between U.S. and Irish law regarding corporate tax residency at the time.
Exactly. U.S. law generally taxes companies based on where they are incorporated.
Right.
Irish law, at the time, generally taxed them based on where they were managed and controlled.
So what did Apple do?
They structured these subsidiaries to be incorporated in Ireland, but deemed managed from the U.S.
So wait, because they were managed from the U.S., Ireland said they weren't a tax resident there.
Correct. And because they were incorporated abroad, the U.S. didn't require them to pay immediate U.S. tax as long as the profits remained offshore.
So in essence, these entities became stateless for tax purposes.
They legally existed, controlled billions in assets and profits, but no major nation claimed the primary right to tax them.
The financial results must have been astounding.
They were. For about a decade, Apple routed over $120 billion through this structure. At one point, internal reporting showed that the effective corporate tax rate on these non-U.S. profits dropped to an unbelievable 0.005%.
0.005%. What is that in real numbers?
That is literally $50 in tax paid for every $1 million in profit generated internationally.
$50 per million. Instead of paying tens of billions in standard corporate tax, they paid a fraction. This is tax avoidance at an industrial scale.
And this lasted until the European Union stepped in. They weren't arguing Apple committed criminal evasion, but rather that Ireland's granting of this specific advantageous tax treatment amounted to illegal state aid, which distorts competition.
So what was the outcome?
In 2024, after extensive legal battles, the EU ordered Ireland to recover approximately 13 billion euros in back taxes. It showed the world that even perfectly legal structures can be retroactively deemed problematic when the scale of avoidance becomes too politically charged.
And the big data leaks have also revealed how common these structures are among individuals, not just corporations.
Right. The Panama Papers in 2016 and the Pandora Papers in 2021 just blew the lid off the commonality of offshore wealth management among the global elite.
Who was involved?
The Pandora Papers in particular were illuminating. They connected over 35 world leaders, presidents, and royalty to hidden wealth held through trusts and shell companies.
And most of it was technically legal.
Almost all of it. But the political fallout was immense. The goal for these individuals, beyond just tax, is to hold assets in deep secrecy, shielding them from local taxes, potential seizures during political upheaval, or, financial scrutiny related to wealth earned while in public office.
And finally, let's tie this back to the buy, borrow, die strategy, exemplified by some high-profile billionaires today.
Figures like Jeff Bezos and Elon Musk are textbook BBD users. They hold massive quantities of stock in their own highly appreciating companies. That's the buy.
Instead of selling that stock, which would trigger a monumental capital gains tax bill,
they borrow against that stock using lines of credit. That's the borrow. They use that tax-free loan cash for everything, ensuring their assets continue to compound without ever realizing a taxable gain during their lifetimes.
it really hammers home the point. They aren't necessarily earning more in the traditional sense.
They're just masters of financial engineering. They ensure the wealth they accumulate is classified as non-taxable appreciation or non-taxable debt.
Classification and control.
That's the entire game.
We have established the what and the who, now we get to the core of it all, the how. Section 3 is about deconstructing the actual complex mechanisms.
Right.
And if we use the Feynman technique here, the goal is to take the seemingly impenetrable fortress of international legal layering and just break it down into simple, manageable steps, starting with the offshore side.
The fundamental goal of offshore structuring is to create multiple legal walls or firewalls between the person and the asset. You want to layer ownership across different jurisdictions, so that if one government or plaintiff tries to reach the asset, they face the legal expense, time, and, frankly, the impossibility of fighting laws across 3 or 4 separate countries.
Okay, so let's go through the steps of this Matryoshka doll structure. That's our second analogy. Layer 1, create a shell company.
You start by setting up a company on paper, a shell corporation, in a low-tax jurisdiction like the British Virgin Islands. The BVI is exceptionally popular because its corporate law is flexible and the registration process is fast and relatively anonymous.
So this company is legally real.
Oh, absolutely. It can sign contracts, hold bank accounts, own property,
Yeah.
but it has no real staff, no manufacturing plant, and maybe just a shared mail address in a place like the Ugland House.
Got it. Layer 2, move the wealth.
This is where the separation occurs. You transfer the assets, real estate, investment portfolios, intellectual property, even private jet ownership into the shell company's name.
So, crucially, the individual no longer owns the assets. The company does.
Exactly. If you, the person, face a legal challenge, you can honestly say you own nothing of material value that can be easily seized because the legal entity owns it.
Okay, then layer 3. Add the trust structure. This is the sophisticated wrapping that finalizes the separation.
A trust is established in a third country, often one known for superior trust law and political stability, like Jersey, Guernsey, or sometimes Switzerland. This trust is set up to become the legal owner of the BVI shell company.
So the trust owns the company and the company owns the assets.
That's the chain.
And the individual.
The individual is only named as the beneficiary of the trust, or perhaps the settler who funded it, but they are absolutely not the legal owner of the trust's assets. This layered structure creates enormous distance.
Ah, so it really is like a nesting doll.
It is. You have the individual inside the core, a company wrapper subject to BVI law, and then a trust wrapper over the company subject to Jersey law. You had to open 3 dolls, each protected by a separate legal system, to find the ultimate source of control.
But wait, this sounds incredibly expensive. Is the barrier to entry for this kind of layering really that high? Doesn't the cost of lawyers, maintaining these entities, and dealing with international compliance just offset the tax savings for anyone who isn't already managing hundreds of millions?
Yeah, that's an excellent point. And the answer is yes, the barrier is extremely high. This complex structure is generally only cost-effective for individuals with net worths exceeding tens of millions, and more typically, hundreds of millions.
What kind of costs are we talking?
The cost of legal setup and annual maintenance can run into the hundreds of thousands of dollars. So it's impractical for the merely rich, but highly profitable for the ultra-rich. For them, the protection and avoidance benefits far outweigh the operational costs.
Let's look at a critical, practical benefit of this structure that we mentioned earlier. Asset protection through debt layering. Why does putting debt onto an asset make it safer from a lawsuit?
Debt is a powerful asset protection tool because of secured creditor priority. If the company owns a $50 million mansion, but that mansion has a $30 million mortgage against it, the bank is the first secured creditor.
And any potential lawsuit.
Any lawsuit judgment that tries to seize the asset has to get in line behind the bank. This often complicates and delays litigation to the point where pursuing the asset becomes economically unfeasible for the plaintiff.
So the goal is to make the asset look messy, leveraged, and legally inaccessible across multiple jurisdictions.
Precisely. You don't make it illegal, you make it uneconomical to pursue.
Okay, moving on to the second mechanism, the buy, borrow, die strategy. This is where the magic of continuous appreciation and non-taxable cash flow happens.
BBD is a philosophy of capital management. It's fundamentally simple. Continuously acquire appreciating assets, use the appreciation as collateral to fund life via debt, never realize the gain by selling, and let the assets pass tax-free to the next generation.
Step 1. Buy appreciating assets. We're talking about highly liquid, reliably growing assets.
Anything that reliably grows long-term. Diversified index funds, real estate in key markets, a successful business. The key rule, which cannot be overstated, is that if you don't sell, you are not taxed on the growth.
And the scale of this is huge.
The ultra-wealthy are currently sitting on an estimated $8.5 trillion in unrealized capital gains that have not yet been taxed.
If they sold that $8.5 trillion tomorrow, the tax bill would be catastrophic.
It would.
Yeah.
So they hold. But they can't just live off zero income. They need cash flow. That brings us to step 2. Borrow against the assets.
This is the genius maneuver.
It is. When they need cash, whether it's for luxury expenses or a new company acquisition, they borrow against the collateral value of their appreciating assets instead of selling them.
And the central benefit here is that loan proceeds are legally classified as debt, not income.
Exactly. Zero tax is owed on the cash extracted. The assets remain fully invested, continuing to compound and appreciate, increasing their overall returns over time, uninterrupted by a tax event.
So they're getting tax-free access to their wealth appreciation without interrupting the growth cycle.
That's in a nutshell.
It's sort of like a home equity line of credit, or HELOC, for the super rich, but on their stock portfolio instead of their house.
That's a great way to think about it. And we primarily see this executed through securities-based lines of credit, or SBLOCs, against brokerage accounts.
How does that work in detail?
A major brokerage firm might offer a client an SBLOC using a portion of their stock portfolio as collateral. If you have $10 million in highly liquid blue-chip stocks, the bank might lend you up to $5 million, or 50% of the value. The cash appears in your account instantly, tax-free.
The power is in the continuous compounding. Your original 10 million keeps growing even while you're spending 5 million. But the leverage itself becomes an investment strategy, what you termed the double dip approach.
This is where BBD users become sophisticated arbitrageurs. The strategy involves borrowing against asset 1 to immediately invest that cash into asset 2.
Ideally, an asset that's uncorrelated.
Right, to diversify risk. For example, using a $10 million stock portfolio to secure a $5 million loan and immediately investing that $5 million into a high-yield real estate fund. Now you have $15 million working for you, funded by only $10 million of your own equity.
And the crucial part is that the return from asset 2 has to beat the interest paid on the loan for asset 1.
Precisely. If your SBLOC interest rate is 5%, but your real estate fund returns 12%, you're making a 7% spread on borrowed money, tax-free upon receipt.
And there's more. The interest itself can be deductible.
It can. Interest paid on loans used for investment purposes, classified as investment interest expense, may be tax-deductible against your other investment income, which further reduces the true net cost of borrowing.
But the IRS is strict on that, I imagine.
Very. You have to be able to trace the loan proceeds directly to the investment purpose, and the deduction is generally limited by your net investment income for the year. It requires meticulous records, but it provides another major subsidy for this strategy.
But there's a massive risk here that we have to clearly flag. The margin call.
Yes, this is the Achilles heel of the strategy. If the asset used as collateral, say that $10 million stock portfolio declines significantly in value, the collateral ratio is breached. The bank will issue a margin call demanding immediate repayment of the loan, or they will start liquidating your assets to cover the debt.
So in a market crash, the BBD user is forced to sell at the worst possible time,
realizing the very capital gains they spent a lifetime avoiding. It's a huge risk.
Okay, assuming they successfully navigated all this for decades. Now, the final step, step 3, die. This is the ultimate tax shield that seals the deal.
The mechanism here is the step-up in basis. This is arguably the single most important rule in U.S. estate tax planning and the cherry on top of the BBD strategy.
Let's use that simplification technique again to explain step-up in basis because it's so critical.
It means that when the owner dies, the tax value of the asset, its basis, resets from the original low purchase price to the current market value at the time of death.
So the appreciation accumulated over their entire lifetime
is completely wiped away for tax purposes.
Let's run the numbers clearly. Say assets were bought decades ago for $150,000 and they're now worth $15 million at the time of death.
If the owner had sold them while alive, they would have paid capital gains tax on that $14.85 million gain. But because of the step-up in basis, the heirs inherit the assets at the $15 million market value.
And if the heirs sell the very next day,
they pay no capital gains tax. That $14.85 million gain, the lifetime appreciation, vanished into thin air for tax purposes.
The entire lifetime of wealth growth has legally bypassed capital gains taxation. But why does a rule that seems so fundamentally tilted even exist? What's the official justification for it?
That's a key political question. The primary defense for the step-up is administrative complexity. Imagine trying to prove the cost basis of assets purchased 50 or 60 years ago. Finding the original paperwork, especially for things like closely held businesses or assets purchased before modern record-keeping, is often impossible. The step-up simplifies the whole process by just resetting the clock.
Even though the side effect is massive tax elimination.
Exactly. And regarding estate taxes, the current exemption is so high, over $13.6 million per person, that very few estates even have to worry about them. For the few that do, other tools like irrevocable trusts are used to minimize or avoid what's left.
It truly is an incredibly elegant and, frankly, infuriatingly effective mechanism for wealth preservation.
It's the perfect end to the strategy.
Moving into our final section, we need to shift focus to the pushback. Governments and international bodies have certainly noticed trillions of dollars sitting offshore and billions in unrealized gains escaping taxation. How are they fighting back?
The regulatory environment has changed dramatically over the last 15 years, largely driven by the public political pressure that followed all the big leaks. The global trend is relentlessly toward greater financial transparency.
And the U.S. has been particularly aggressive in tracking its own citizens' wealth abroad, right? Using things like FESA.
Right. FESA, the Foreign Account Tax Compliance Act from 2010, was a game changer. It essentially weaponized the global banking system. It forces foreign financial institutions to sign agreements to report accounts held by U.S. taxpayers directly to the IRS.
And if they don't comply?
They face significant penalties on their U.S.-based operations.
That sounds like it single-handedly killed classical banking secrecy for Americans.
It did, almost overnight. It made simple personal concealment incredibly difficult. You combine that with the Bank Secrecy Act, which flags large transfers and suspicious activity, and the old opacity is largely gone for individuals from major developed nations.
And globally, there's been a parallel shift toward information exchange.
Many countries are signatories to international agreements that require them to automatically share data on foreign-owned accounts. The old model of just setting up a bank account in Switzerland and expecting absolute silence is, for the most part, gone.
But the sophisticated structures we discussed still work.
They do. The layered trusts owning shell companies still provide massive obfuscation, often because the legal definition of ownership is so far removed from the individual.
But what about the corporate side, targeting that massive Apple Ireland problem?
That is the driving force behind the global movement for a global minimum tax. Over 140 countries are negotiating a worldwide baseline corporate tax rate, aiming for 15%.
And the goal is just to stop the race to the bottom.
Exactly. It's to reduce the primary incentive for large multinationals to endlessly shift profits to zero-tax jurisdictions.
How effective has the implementation of the global minimum tax been so far?
Well, the implementation has been slow and challenging. Reaching an agreement is one thing. Actual legislative implementation is complex and requires domestic tax reforms in dozens of countries. The U.S., for instance, hasn't fully adopted the necessary reforms yet.
And has this push for transparency had any unintended consequences?
It has. Ironically, it's shifted some of the secrecy from classic island havens to large developed economies that offer their own favorable rules.
So we're seeing a rise in domestic offshore centers.
We are. We're seeing certain U.S. states, specifically Delaware, Nevada, South Dakota, and Wyoming, that offer incredibly strong trust laws, allowing for perpetual trusts and extreme asset privacy that rival the traditional Caribbean havens.
So a foreign billionaire can achieve the same goals by setting up an entity in a U.S. state.
In many cases, yes. They can leverage the stability and legal protection of the U.S. system, far removed from the jurisdiction of their home country. It's domestic avoidance undermining international transparency efforts.
Let's move to the most critical part of this discussion, the societal conflict. Why does this matter if you're not a billionaire setting up an irrevocable trust?
It matters deeply because of the direct, quantifiable impact on ordinary taxpayers and public services. When trillions of dollars in gains and profits are shielded from taxation legally avoided, governments must recoup that lost revenue somewhere.
And that means they turn to the most visible and least mobile sources of income.
Exactly. They raise taxes on wages, on payroll, on consumption, on small businesses, the economic activities that can't be easily shifted offshore or classified as debt. Or they have to cut public services like healthcare and education.
So your tax bill or the quality of your local school is directly affected by this.
It is. And this feeds directly into the critical issue of increased wealth inequality.
This is the mechanism driving the wedge.
It is. These structures allow the wealth of the top fraction of a percent to grow exponentially faster, uninterrupted by taxation, while their living expenses are paid for with tax-free loans. Their effective tax rate is drastically lower than that of a high-earning salaried professional who pays 40% on every dollar immediately. This acceleration of untaxed wealth concentration just fundamentally widens the wealth gap.
And finally, the erosion of trust in the system itself.
Public trust is severely undermined when leaks expose that the financial rules are fundamentally different for those with wealth and those who rely on wages. When the tax code actively facilitates this kind of avoidance, it undermines faith in democracy and the concept of equal application of the law.
It's a clear tension.
It is. The individual's legal right to financial privacy versus society's essential need for transparency and a broadly fair functioning tax system. That conflict is defining our political and financial landscape today.
Before we wrap up, let's identify some specific areas where this exploration can continue. You've been given a tremendous amount of high-level, simplified information today, but the complexity here means there are still significant knowledge gaps to bridge.
I have 3 specific questions for you to explore next that build directly on what we discussed and will take your understanding to the next level.
Knowledge gap 1. We briefly mentioned irrevocable trusts for minimizing estate taxes. How exactly do the various specialized types of irrevocable trusts, like a SLAT or a GRAT, function to legally remove assets from a taxable estate? And what are the detailed limitations or ongoing administrative costs involved?
Knowledge gap 2. Regarding the global minimum tax, we know implementation is challenging. How effective has the rollout been so far? Which major jurisdictions are currently resisting or offering alternative low-tax structures? And how are mechanisms like patent boxes being exploited to create new avoidance pathways?
And knowledge gap 3. We emphasize the borrow step using SBLOCs. What are the precise current legal requirements and minimum asset levels typically required by major brokerage firms to establish an SBLOC? And how has the profitability of the interest rate arbitrage, that double dip, changed now that interest rates are significantly higher?
Exploring those three areas will ground you even further in the practical execution and current regulatory environment.
This has been a fascinating journey into the infrastructure of wealth.
It has. We've seen that the tools, the offshore companies, the trusts, the concept of leverage, the step-up in basis, are often neutral legal vehicles. But their aggregation facilitates both legitimate wealth protection and aggressive, sometimes structurally abusive, tax avoidance.
The real question, the one we want to leave you with, is not whether the rich are breaking the law, but whether the laws themselves are structurally fair when they allow wealth generated over a lifetime to legally bypass taxation entirely upon death.
Should wealth appreciation, regardless of sale, eventually face a baseline tax, whether it's a direct wealth tax or a tax on appreciated assets at death, to fund the societies and public institutions that enable such massive wealth creation in the first place? It's a question that challenges the very definition of fairness in the 21st century.
We'll see you next time.